Let's get to the top story, which is Disney. It's not Disney reporting earnings. And look, I feel like I'm always ragging on Disney. I'm just being honest. I wish I could be more positive. It's not personal, right? And I looked at the projections yesterday, and I told Daniel to come in here and look at this. Disney was projected yesterday, right? They reported this morning to report earnings of $1.05. I thought that was a disgrace from analysts. So analysts would buy ratings, lowering their estimates so they could easily beat that number. Now, why is that an easy number to beat? Because you're going to see on TV, they actually beat that number. They actually beat that number. I think they beat it by 6 cents and reported like $1.11 or something. And I thought they were going to report $1.20, $1.30. Why? Because when you look under the hood at $1.05, guys, that represents negative growth of 8%. 8%. So when Disney came in this morning, I was telling Dave, I was like, they're going to report $1.25, $1.30. Stock's likely to go up and then pull back, right? Because even at $1.20, $1.25, you're not seeing that year-over-year growth in earnings. I mean, how is that possible? So you see negative year-over-year growth. People are just looking at the number, and they came in, they didn't even beat that number by that much, and then they also missed on revenue. You know, coming in at $1.11, which implies the company's still seeing negative earnings growth of about 5%, missing on revenue, and the guidance was, we'll see double-digit guidance. We heard that story so many times. I mean, we heard that story from 2020 to 2022, 3, 4. We haven't seen it, right? This huge growth. We're still waiting for it. So the stock's getting hammered today. It was down 10%. It's probably down about 5-6% right now, last time I looked. Now, why is that happening? First, CFO Hugh Johnston is treating its investors like they're complete idiots, which I hate. I hate when CEOs do this. I hate this. Because he goes on Squawk Box, says, overall, we're leaving the year with a lot of momentum. This is regarding the company's streaming and experiences businesses. And investors are looking at that saying, this was a layup quarter for you to beat. The stock should be up 10 to 15% today. Finally, showing the bottom it was in. We're seeing growth across our platforms. We're dealing with the linear garbage, ESPN, whatever, even though ESPN is not on YouTube for a long time now. I think it's like 2 weeks, 3 weeks now, which is insane. Then they can't come up with a deal. I mean, that's huge. You know, the ESPN property, they're shedding subscribers. They can't get the gambling going. They cancel with Penn. I mean, it's so much garbage. Remember, they were going to start a special sports network, I think, with Warner's Discovery and Paramount, and then that didn't go. Like, they just can't find a way to make this platform grow anymore when it comes to ESPN. Then you have linear, which is bad. Parks is always doing okay. But now the pricing power on Parks, people are like, F this. I mean, it's just too much money. I'm going to go to other places, whether it's Universal or whatever. So that's first. When you have the CFO going on TV treating you like an idiot, when your stock is down, don't say, hey, man, we love it. Momentum's great. Don't say that. We're not idiots. Don't say that. Second, and more importantly, Disney, as you know, has been in cost-cutting mode for how long? You know how long? Since November 2022. That's when Bob Iger came in as CEO and said, okay, we got to get rid of employees. We got to get rid of DEI. Most of it. They still have DEI, as you can see with Snow White and stuff like that, which, you know, again, one of the worst performances ever. They also had Toy Story come out with you showing kids stuff that their parents don't want them to see, and your parents is that demographic, not the kids. The parents taking their kids to these places. Okay, there's a TikTok video out there too that's also on Instagram showing how someone waited an hour and a half, 2 hours to go see a Disney princess, and they had a mustache. That's your target market. That's your target market. There's nothing wrong with how you want to be. Just don't put that in front of your kids when people don't want that. And it's that simple. This is a business. This is a brand. So Bob Iger came back, started cutting costs like crazy, executive positions, cut content costs, which is a terrible, horrible long-term strategy because it's going to result in subscribers fleeing the platform because you don't have good content. Especially, not only did you cut content, at the same time, you're raising prices, throwing commercials all over the platform. And congratulations, keep that thought, to CNBC. CNBC did a great job putting this chart up, and I'm going to show you this freaking chart. Look at this. So this is the price increases among every platform since 2019. Netflix increased prices by 38%, Paramount 40%, Hulu 58%, which is Disney, Peacock 120%, Apple TV 160%. You know who increased their prices the most? Disney, by 172% since 2019. Okay, because you're talking about a company that has weak content on it for Disney Plus. Again, people don't go into streaming to watch Dumbo or Snow White 80 times. They want to see new content. Stranger Things is coming out next week or in a week and a half. People are dying to see it. They're going to go, that's why people buy Netflix and they stay on it forever because there's always this great new content. Same with HBO, which is, Warner Brothers. Same with Prime. Same with Apple. I mean, F1 with Apple, with Brad Pitt constantly, right? They just to put in perspective, I think I heard they spent $300 million in marketing for that F1 movie with Brad Pitt. And they probably made a small profit. I mean, if you think about what they're paying and who the competitors are, it's incredible. But this is Disney. Disney's cutting costs. Okay, when a company cut costs, what happens? Your earnings go up, and sometimes your sales are going to come down a little bit, right? Which is fine. Okay, because you're cutting costs and people want to see growth in earnings. And what do we see? Okay, we saw lower revenue, but we're not seeing growth on the bottom line. They're not transitioning to bottom line growth, which means what? More cuts are likely coming. And Disney tried to pad the damage on the call, saying, hey, we're doubling down our buyback to $7 billion, which is less than 3% of the float, which is nothing. They increased their dividend by 50%, which to me means Disney's throwing in the towel on growth and becoming an income stock. I mean, even with the increase in the dividend, it still pays below the average yield in the S&P 500. I don't get it. Exxon the same way. I don't understand Exxon's performance has been great, but I hated when their dividend was 8-9%. I'm like, cut it in half. You lose some of the investors, big deal. Now, I mean, it results in billions and billions of dollars that you could buy. This is when oil was really crashing a few years ago, where you could buy all these assets dirt cheap, which could go up 10x plus instead of paying your dividend, which is still going to have an above average dividend. They kept it, and that's fine. But I'm just saying, imagine the assets you would have purchased. I think Exxon stock would be up so much more because you would have purchased those assets at 10 cents on the dollar, and now they're all reaping the rewards of those assets. With oil starting to, come, I think oil's great to buy right now. It's just so hated, and international growth, everything. I won't get it, to total another conversation. But if you look at Disney and what they're doing, it makes no sense because they should be using this cash to grow the company. That's what investors want. They want to see growth. You want the multiple of Netflix. That's why you went to streaming. So you got to grow the platform. You can't cut content costs. It doesn't make sense what they're doing. The management's all over the place, and their growth model makes no sense because you're looking at streaming, you're cutting content, you're raising your costs, you're putting commercials all over it, and that business, you're competing with the greatest, biggest companies in the world that easily pay $10 billion in content, whether it's Netflix, whether you're looking at Prime, which is Amazon, whether you're looking at YouTube, which is Google. This is their secondary, third, fourth business lines that they don't even really care about. I mean, they care about them, but they have so much more to spend on this content and can afford to lose money, which Disney can't. And you're in the wrong market here with streaming, which, by the way, they were forced to start because during COVID, every one of their business lines were impacted more than anyone. Cruise lines down, plays down, Hollywood studios down, your parks are down, right? They had no choice. Let's do streaming. And, they had this beautiful model. The stock went to 180, 190. We called them out on it and said, look, they're adding all these people where they're giving them for free, that it's international clients paying $2 a month. And it blew up in their face because after the stock was that high, they were like, okay, what's the average revenue per user? Oh, it's 80% below Netflix. You're not making money on these. And that's when they reshuffled their divisions. I mean, it's been a shit show long enough for investors. I mean, come on, get your act together. There's no excuse. Iger's at the helm. There's no excuse for this company. No excuse. You even had the analysts in your favor, lowering estimates so it was a layup for you to beat this number, even though you're still seeing 8% year-over-year growth, negative growth in earnings. How's that possible with all the cost cutting? The stock's now trading at $107 a share. That's lower than the $114 a share Disney was trading in 2015. Are you kidding me? You talk about a lost decade. And look, if you want a bottom fish here, and you're going to see probably on Fast Money today, and people are like, oh, it's dirt cheap. It's not cheap. That's 17, 18 times forward earnings, and they're not growing earnings. They're praying to get a market multiple at Netflix. Netflix is, if you really want to buy, this is what I tell everyone. Disney could be higher from here. It could go 20% higher from here over the next 12 months. But I could tell you, you're going to lose money when it comes to the opportunity cost because you got the opportunity to buy Netflix here and that pull back a little bit, which is growing like a weed and in the first inning of advertising, which is going to be massive. It's almost like you're getting in cloud for the first time. I'm going to talk about Cisco. Cisco was late to the party in AI. That stock is at its all-time high. The first time it's at its all-time high since 2000. Just beat out that price in 2000. One of the biggest stocks in the world in 2000, and the market crashed. Finally, they just surpassed that to be at an all-time high, even though they were late to the party in AI. And switches and stuff like that, which we chose to buy Celestica at 40, and it's over $300 and whatever, $30 now. Because we knew that companies in AI need switches and things like that. You can't build data centers without all the components. That was a component everyone needed. Celestica provided for them. Now Cisco's providing as well. But if you're really looking at bottom fish here, guys, you need to rethink it because, yes, Disney could go up, but do you think it's going to go up more than Netflix? You could buy Amazon with Prime, right? If you want to buy a streaming platform, Google with YouTube, Apple TV. which is going to give you exposure to streaming, which should be the reason why you're buying Disney, not really for parks, and definitely not for linear. And now those companies, Amazon, Google, Apple, come along with massive growth markets like cloud and AI. And then you have streaming. Not only that, all the sports rights. These guys could write a check for $5 billion with their eyes closed, and they would forget about it a week later and be like, wait, how much was that check? $5 billion or $6 billion? Oh, I don't know. Okay, we're good. We got the rights to football for Thursday nights if you're Amazon. And now what does that do? Amazon's able to filter it down to Prime. Well, you need to be a Prime member in order for you to get that NFL Thursday game. And now everyone signs into Prime, and now you get Prime. I mean, you order something on Prime, and it's like the second you press in the cart, you're like, okay, you bought it. It's like someone knocks on your door 5 minutes later and says, here's your package. I have no idea how they do it. I have no idea how to do it. But these are the companies that Disney's competing against. I mean, YouTube TV's on fire, destroying Hulu, which has a little bit of new content. But Disney Plus is a disaster. So what do you want to do? You want to buy Disney here, which is expensive at 17, 18 times forward earnings, not growing earnings? Or do you want to buy these other companies, which are trading at higher multiples, but growing like weeds? I mean, they're buying back stock, but as a percentage of float, it's smaller than these big names are buying back. If you're looking for the dividend, which they increased the dividend, I have no idea why you would do that when you're seeing negative growth in earnings. You say, well, cash flow is decent, but I don't care. I mean, I'm not buying Disney for a dividend for a 1%, 1.2% dividend when I can go to Robinhood or Interactive Brokers and they're going to pay triple that, or at least more than double that. And you don't have to take on the risk owning a stock like Disney that has been operational a freaking disaster. If I had a bet, if I was going to bet, I would have bet that Disney would be up 10% today, not down 10%. Which means it's down 5% now. And Cramer's all over it saying, well, I don't know, the value there. We've been talking about this for such a long time. When your growth model is competing against the biggest companies in the world and you can't afford to outbid them and put in more content, and you're raising prices on a platform that you're throwing commercials everywhere, all over the place, and providing a worse experience, Chipotle is the same thing. You're going to raise prices tremendously and you're going to give people less food, and then your stores are shitty and they're not fun to go into anymore. I remember the music used to be playing, lines and stuff. Now even the meat's not that good. It's not ready. You got no lids and stuff. I mean, this is like several places, a bunch. Go on Reddit and see. And you're going to see everybody talk about how terrible the experience is and the food. It's there. That's what you have to look at when it comes to some of these stocks. Is Disney providing a good experience? No. That's why I say never short a stock that has a really great product. I mean, Einhorn learned that with Keurig. If you got a great product and people love it, they're going to pay a premium for it. And yeah, your stock's going to be trading at a premium, but if you're growing, you got to grow into that. With Disney, they want this premium multiple they want to trade at, but they're not growing earnings. I mean, this isn't working. You have to have a reset and figure this stuff out. One of the best marketing companies on the planet, one of the best storytellers on the planet, and yet you're ruining that going into subjects that people don't like, which is your core market. I don't get it. There's no excuse there's no excuses anymore. Chapek was a bum. He's a loser. He's a bum. He destroyed this freaking company. And then you got Iger coming back and he knew it and said goodbye. All right, well, cutting costs. Okay, the cost cutting work. Now you should be seeing growth. You cut costs. Now you should be seeing growth, and you're not seeing growth. What's going on? I don't get it. So I think Disney stock could go higher from here, maybe, but it's not going to go higher than Netflix, Apple's, Amazon's, Google's. They're not. You're better off buying those. And I really think this quarter, you're going to lose a lot of investors who stuck around for a long time saying, okay, here it is. We're going to come in. I mean, the expectations for Disney report a good quarter were very, very high going in. And now it's like you got to throw in a towel because you're like, your guidance wasn't that great. You have the CFO saying, hey, we got great momentum after 10 years. Where's the momentum? Your stock is getting annihilated. Look at your stock price before you go on Squawk Box next time in the aftermarket, which is the pre-market, but pre-market because they reported this morning. Look at your stock when you're doing that interview next time, because if it's down, be like, we got to do a better job. We're almost there. That's a better message than saying, hey, we got great momentum. I mean, you should open the slap league, open slap. It's an open slap to your investors as hard as you can. Like a investor be looking at you, should slap in the face and say, you're an idiot, okay? You're an idiot. This is what we were telling you. Our subscribers, our investors are a bunch of idiots, okay? That's who we talk to. Well, they're not idiots because they're selling the shit out of your stock and they're done. Something's got to be done there. It's a disaster. It's horrible. You're competing against the wrong people. The streaming's not working. Go back to your core. I wish I was CEO of that company. I'm not even being arrogant. If I was, that stock would be double the price. Open up thousands of parks all over the place. Stop competing. Stop with the streaming platform. You have your content. All these guys need content. License all the content out. License it out. You're getting free checks. It's like a royalty company. Money's coming in instead of creating your own platform that clearly doesn't work and you can't afford the content costs. Now, all your movies and your best content doesn't even come on the streaming platform first, right? If you're looking at Pixar, if you're looking at the Avenger movies, All that stuff comes out in the movies first. Now you get it. You license all that stuff to all these platforms. You make a fortune. But man, figure it out, because ESPN, how long is ESPN going to be a disaster? It's been 7-8 years. It's been a disaster. You still haven't figured it out. Still haven't figured it out. And people hate partnering with them. Even YouTube, right? They can't get negotiations for YouTube to have ESPN on YouTube. You know how much of a disaster that is? I don't think you can own Disney here. You can. You might go up a little bit, but the opportunity cost is there's a lot of better names in the space than them. And horrible. I mean, horrible quarter. I was very surprised. I thought Disney was going to come back. I was going to talk positive on it. There's nothing going right, that company right now. And I love watching CNBC because every single quarter that they do this for the last 5 years since COVID, they're like, Disney's a buy. It's going up. It's going higher. It's great. It's this and that. What are you talking about? Even the analysts who have a buy rating don't like it because their estimates are horrible. It's like, let me put a buy rating and lower the estimates. This way they beat and it goes higher. Didn't work this time. You beat estimates, you're still showing negative growth year over year. What massive cost cutting? I just don't get it. I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. I'll tell you specifically what moves you can make today. Specific investment ideas I'm recommending and tracking each week. Also, the news we're picking up from our network of insiders. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today and you won't miss a thing. That's WSUoffer.com.